So my name is Dr. Amira binti Jamil. I'm a senior lecturer from Faculty of Entrepreneurship and Business, University Malaysia, Kelantan, and will be your instructor for this topic. This topic is designed so that you can illustrate the overall process of accounting. The learning objective of this topic is for you to be able to distinguish between the different types of business organization, the different between accounting and bookkeeping, and also for you to be able to identify the users of accounting information. There are different types of business organization, and in this topic we will introduce you to these three types of organization. The first one is the sole proprietorship, which is a business owned and run by one individual with no legal distinction between the owner and also the business. The second one is partnership, which is a business owned by more than one person. And the third one is limited liability company, which is a business entity with owners, which is the shareholders, whose liability is limited by shares. These are the characteristics of all the three types of business organization and the difference between the organization and also their characteristic. And the first one is about registration. Sole proprietorship is registered with the Business Registrar under the Business Registration Act 1957, while partnership registered with the Companies Commission of Malaysia under Business Registration Act 1956 and 1957, whereas the limited company registered with the Companies Commission of Malaysia under the Companies Act 2016. The capital for sole proprietorship is contributed solely by the owner because it is only one individual business, whereas for the partnership, the capital is contributed by partners according to the Partnership Agreement or Partnership Act 1961, whereas for the limited company, the capital is contributed by shareholders through the purchase of company shares. The ownership of sole proprietorship following the capital contribution is owned by one person. As for partnership, it can be owned by 2 up to 20 partners. However, professional partnership are owned by 2 up to 50 partners, whereas for limited company, a private company must have a minimum of 1 and a maximum of 50 shareholders, similar to the professional partnership. A public company, on the other hand, must have a minimum of 1 and the maximum number of shareholders. In terms of management and control of sole proprietorship, it's easy because it's owned by only one individual, so everything is being controlled by the owner. Whereas for partnership, it is being controlled by the partners or by a board which consists of a few partners. For limited company, the management and control by a board of directors appointed by the shareholders. For sole proprietorship, the liability is unlimited liability, meaning that if the business fails and the assets are not enough to cover the debt, the payable have a right against the owner's personal properties. For partnership and limited company, both have limited liability. For partnership, The limited liability is only if it is a limited liability partnership, meaning that each partner is not responsible or liable for another partner's wrongdoing or carelessness. Unlimited liability if it is traditional partnership under Partnership Act 1961, similar to the sole proprietorships. If the business fail and the assets are not enough to cover the debts, the payable have a right against the partner's personal properties. For limited company, it is totally limited liability, meaning that if the business fail and the company assets are not enough to cover the debt, the payables do not have a right against the shareholders' personal properties. For profit or loss, for sole proprietorships, it belongs totally to the owner, and any losses incurred by the business will be borne by the owner solely. Whereas for partner, it will be shared to the partners according to their profit sharing ratio. For limited company, the profit will be paid to the shareholders in the form of dividends. For books and account, for sole proprietorship, there is no legal obligation to keep the books and prepare the accounts. Similar to partnership, there is no legal obligation to keep the books and prepare accounts. So we have learned about the different types of business organization. In this slide, we will explain to you about the difference between accounting and bookkeeping. Accounting can be defined as the art of classifying, recording, and summarizing transaction and business events in monetary terms and interpret the result to interested party to enable them to make decision. It involves 4 stages. The first one is classifying, recording, summarizing, and also interpreting. Whereas for bookkeeping, is different from accounting as it only a part of accounting. It refers to the mechanical aspect of accounting, such as classifying, recording, and summarizing transactions systematically. So, who are the interested party of accounting information? Okay, the users for this accounting information, it can be classified into 2. The first one is internal users. For example, the owners, managers, and employees of the business, of the organization. And it can also be external users. For example, the creditors or the bankers, investors, the government, and also the consumers. So what are the difference between those two? The internal users are those who work in the organization. Okay, for example, the owner, they are interested in the profit earned from their investment, the financial stability and growth of their business. So that's why they require accounting information. Whereas for the manager, they need information as guidance in planning, organizing, and control the organization, and also to analyze the operation of the business. Whereas for employee, they might interested in the accounting information to know the business ability to progress and expand. They look for steady employment, earning capacity, and other monetary benefits that are to be gained from financially stable business. So that's why employee might be interested in accounting information. Other than internal users, external users might also be interested to obtain the accounting information. The external users are those who are indirectly involved with the organization. It can be the payable, the bankers, which they might interested to know the ability of the business in repaying the amount owed them. and can be also for the current and potential investors that require information regarding the solvency and financial strength of the business, its present and future earning capacity, and the ability of the management to maintain or improve the business current or future performance and financial position. The government also might be interested in the financial statement and report of business for tax purpose. Okay, and also for the consumer of product or services, they might be interested in the establishment of good accounting control as a means of reducing the cost of production, selling and distribution, and hence the reduction of the prices of the goods they purchase. The accounting process starts with recording the business transaction, the detail of which are taken from source document. The source document are different types depending on the type of transaction. For example, it can be in the form of invoice, bill, receipt, debit notes, credit notes, and also vouchers. The transaction are then classified and recorded in the appropriate books of prime entry, such as cash book and journals. Journal can be classified into the general journal, purchase journal, sales journal, return inwards journal, return outward journal, and cash payment and receipt of journal, which you will learn further in module 4. And after the transaction are recorded in the journal, the total will be posted to the appropriate accounts in the ledger, and this process is known as posting. And ledgers can be classified into the general ledger, sales or debtor ledger, and purchase or creditor ledger, which will also be explained further in the next module. At the end of the month or at the end of the accounting period, a trial balance is prepared. The purpose is to check whether or not transactions have been recorded correctly in the books of account. Adjustments have to be made if there are errors. Adjustments are also made at the end of accounting period for accrual and prepayment of revenue and expenses, doubtful debts, and also depreciation. Finally, the financial statement can be prepared by obtaining information from the list of balance in the trial balance. Financial statement include statement of profit or loss and statements of financial position.